What if I told you that one of the most safest, most boring financial decisions you could make in your 20s could turn 10,000 a month over to rupees 10 lakhs without you doing a single thing after first setup? Most people in India are either sitting on fixed deposits or worse. Their money is just sitting in a savings account earning 3.5%. And I get it. Mutual funds sound scary. Market goes up, market goes down, and no one tells you what actually happens to a real person's real money over a real 5-year period. So today, we're going to fix that. I'm going to show you exactly what happened when someone just like you invested 10,000 every single month for 5 years. The good months, the scary months, the COVID crash, and the final number that made it all worth it. Let me introduce you to Rahul, 27 years old, software engineer in Pune. Earns 55,000 a month in hand, pays rent, sends some money home, enjoys the occasional Swiggy order and a trip to Goa every year. Sounds familiar? Rahul is not a finance expert. He's not watching Bloomberg or reading Buffett's letters. He just knew one thing: keeping money idle was costing him. In early 2019, Rahul walked into a financial advisor's office. Not because he had surplus money, but because he had been telling himself that I'll start next month for 2 years. Sounds familiar again? The advisor ran him through a simple risk profile questionnaire, risk appetite, time horizon, goals, and recommended a simple portfolio. Large cap fund, 4,000, stability and blue chip exposure. Flexi cap fund, 4,000 rupees, growth across market cap sizes. And ELSS for tax saving, monthly SIP, 2,000 rupees for ATC reduction and equity returns. So total SIP is 10,000 per month. Start date is January 2019. And it is December 2023. 60 months, let's go. Before I get into the year-by-year numbers, drop a comment right now. Are you currently saving money every month or are you still in the next month club? Year 1 was underwhelming. And actually that's a good thing. Rahul put in 1,20,000 over 12 months. Markets were decent in 2019. Sensex went from 36,000 to about 41,000. His portfolio was roughly 1,28,000, a gain of about 8,000. He almost stopped. 8,000 profit after 12 months. His colleague was bragging about making 15,000 on a single stock tip, but Rahul stayed. That discipline, that's the whole game. And then COVID happened. March 20, the Sensex dropped 38% in 40 days. Fastest market crash in history. Rahul's portfolio, which had grown to about 2.1 lakhs, was suddenly worth 1.4 lakhs. He called his advisor in panic. Should I stop the SIP? Should I withdraw what's left? And his advisor said something that sounds obvious but now felt insane at the same time. Don't just hold. Increase your SIP if you can. You're not losing money. You're buying units at a 40% discount. Rahul didn't increase. He was too scared. But he did the second hardest thing. He did nothing. He let the SIP continue. And by December 2020, the Sensex had just not recovered, it had crossed its previous high. His portfolio, rupees 2.9 lakhs on a 2.4 lakh investment. 2021 was the opposite of 2020. Markets went into full bull run mode. Sensex went from 47,000 to 58,000. Rahul's portfolio grew from 2.9 lakhs to nearly 5.4 lakhs. This is when the real psychological test begins, not fear but greed. His friend, who had paused his SIP in March 2020, restarted it in January 2021, right when units were expensive again. He missed the entire recovery rally. Rahul kept going. He even increased his ELSS SIP to 3,000, partly for tax saving, partly because he finally trusted the process. 2022 was the year that tests patience. Russia-Ukraine war, US Fed hiking rates, FIIs pulling money out of the Indian markets. The Sensex swung between 51,000 and 62,000 all year, going nowhere fast. Rahul's portfolio barely moved. Rupees 5.4 lakhs in January, 5.7 lakhs in December. 11 months of SIP, 1.1 lakh invested, and the portfolio barely budged. But here's the thing. Every 10,000 SIP in a down or sideways market buys more units. Units that are waiting to appreciate when the market recovers. This is called 2P cost averaging. And this is where SIP quietly does its best work, even when it doesn't look like it. And then came 2023. The Sensex crossed 72,000 for the first time. IT sector recovered, mid-cap went absolutely berserk. And Rahul's portfolio, rupees 9,87,000. almost rupees 10 lakhs on rupees 6 lakhs invested. That is a 64.5% absolute gain, a CAGR of roughly 10.8% per year. Now, some of you watching this are going to say, the markets were good in this period. And yes, they were. But here's the comparison Rahul's advisor ran for him. The difference between a savings account and a mutual fund SIP over 5 years for the same 10,000 rupees per month is over rupees 3 lakhs. That's a laptop, a two-wheeler or a solid international trip. Okay, one thing no one talks about in these videos is taxes. Rahul's 3.87 lakh gain is subject to long-term capital gains tax, 10% on gains above rupees 1 lakh. So, 3,87,000 minus 1 lakh is 2,87,000 taxable gain. At 10%, that's 28,700 in tax. And net profit is 3,58,300. Still 2.5 lakhs more than FD after tax. The math still wins. And his ELSS units locked in for 3 years per tranche, but fully grown. And the tax saving under Section 80C over 5 years alone was nearly 60,000. That's the money he got back from the government for investing. So, I asked Rahul, if you could go back to January 2019, knowing what you know now, what would you do differently? Rahul said 3 things. First, start earlier. He wasted 2 years telling himself next month. If he had started at 25 instead of 27, even with the same rupees 10,000, those 2 extra years of compounding would have added roughly rupees 2.4 lakhs to his final corpus. That time is the variable that money cannot buy back. Lesson 2. Increase SIP annually. Rahul kept his SIP flat at rupees 10,000 for most of the 5 years. A simple rule. Increase your SIP by 10% every year. Lesson 3. Don't pause during panic. In March 2020, Rahul almost stopped his SIP. He didn't, but many people he knew did. Those who paused for even 3 months missed some of the cheapest unit prices in years. The panic pause is almost always the wrong move. Here's the truth. Rahul's story isn't exceptional. It is available to anyone who starts. The difference between people who build their wealth in their 30s and 40s and the people who wonder where their money went is usually just this one decision. Start an SIP and don't stop. Now, I know what some of you are thinking. Okay, but which ones are right for me specifically? My situation is different. And you're right, it is different. Which is why contact us for further briefing.